All right, class, welcome. So we've spent a lot of time on the fundamentals, right? The debits, the credits, all the basics. But today we're going to level up. We're moving beyond just recording transactions to something much more exciting, using accounting to make massive strategic business decisions. This is the stuff that really separates a bookkeeper from a future CFO. It's about learning to read the story behind the numbers. And to do that, we're going to dive headfirst into a really detailed, real-world scenario, the kind of thing you'll definitely see out there in your careers. Okay, so let's put you right in the hot seat. Imagine this. You're the lead analyst at a big company. A huge acquisition is on the table, and you're in charge. The target? It's this hot tech startup, Innovate Inc. They're the talk of the town, they've got some game-changing technology, and the price tag is a cool $50 million. Everyone is looking at you. Your boss walks into your office and says, "So, what's your recommendation? Is it worth it?" This isn't some abstract problem from a book. No way. This is the kind of high-stakes, career-defining decision that you are being trained to make. So how do we even begin to answer that $50 million question? Well, the first thing to know is that you can't just look at the obvious stuff. I mean, you can't just walk into their office with a clipboard and start counting laptops and chairs. That might have worked 50 years ago, maybe, but not today. Especially for a tech company, their real value, it's usually not in the physical things. It's in the stuff you can't touch. And to get a handle on that, we need a whole different, more sophisticated set of tools from our accounting toolbox. Okay, look at this. This table really lays out the puzzle, doesn't it? On one side, you have your company, CPG Corp., $1 billion in tangible assets, factories, inventory, the whole shebang. Then you look at the startup, Innovate Inc., just $2 million. Two. But they're asking for $50 million. So where's that other $48 million coming from? That is the mystery we have to solve. And that gap, well, that's where the real value is. It's their brand, their technology, their big ideas. Our job as smart decision makers is to figure out what that invisible stuff is truly worth. So that $48 million gap, how do we actually account for it? How do we put it on the books in a way that makes sense? The answer, and this is our first big topic for today, is a concept called intangible assets. Think of these as the specific accounting tools we use to measure all that invisible value, the stuff that, as we can already see, is often the most valuable part of a modern company. So let's really dig in and see what these are all about. So what is an intangible asset officially? Well, it's pretty straightforward. It's an asset you can't physically touch. But, and this is the absolute key, it's something that's going to generate economic value for you down the road. Think about the patent for a life-saving drug, or the source code for an app like Instagram, or even just a really powerful brand like the Nike swoosh. You can't hold any of those things in your hand, but wow, are they valuable. Now, figuring out exactly what they're worth, that's tricky. Accountants will project how much cash the asset might bring in over the years, or they might look at what similar patents or brands have sold for. It's really part science and part art. Okay, so let's bring this back to our startup, Innovate Inc. What's their big, intangible asset? Well, after some digging, you discover they hold a game-changing patent for new type of software. And that right there, that is the heart of the valuation. That's what you're really paying for. Forget the desks and chairs. You are buying the exclusive, legally protected right to own this technology and all the future profits it can generate. This patent is the crown jewel of the whole deal. But what if we do the math? We get the patent professionally appraised, we add the $2 million in physical stuff, and it still doesn't get us all the way to $50 million. What if there's still a gap? Well, that's where this really interesting and often misunderstood concept called goodwill comes into play. Goodwill is basically the premium you pay for everything else that's great about the company, but that you can't put an individual price tag on. It could be their amazing reputation, their super loyal customer base, their brilliant engineering team. You can't value those things separately, so we bundle them all together as goodwill. Now, here's the important part. It's recorded as an asset, but you have to check it for impairment regularly to make sure you didn't overpay. All right, so you've bought this patent, but here's the thing. It won't last forever, right? Patents eventually expire. Now, you all remember depreciation from earlier chapters, how a truck or a machine loses value over time, and we expense that loss. Well, intangible assets have something very, very similar. It's called amortization. It is essentially depreciation, but for intangibles. We're following the matching principle here. We spread the cost of that patent over its useful life, matching the expense to the years it's helping us generate revenue. So every year, a little piece of that patent's value gets moved from the balance sheet to the income statement as an expense. It's a non-cash expense, but it's crucial for getting a true picture of your long-term profitability. Okay, let's zoom out for a second and think about the big picture. This $50 million deal, it's not like buying office supplies. You don't just expense it and move on. This is a huge strategic bet on the long-term future of your company. And because of that, on your balance sheet, this entire acquisition is going to be classified as a long-term asset. Understanding where things fit is so important for seeing a company's overall strategy. So when you look at a balance sheet, you'll see assets are basically split into two big buckets. First, you've got your current assets. This is the stuff you expect to use up or turn into cash within a year. Think your actual cash, your inventory, things like that. It's what you need to keep the lights on day to day. Then you have your long-term assets. This is the stuff you're holding onto for more than a year to really grow the business. And our new investment in Innovate Inc., with its patent and goodwill, that fits right in here. This distinction is absolutely critical for anyone trying to understand if a company is just surviving day to day or if it's actually building for the future. Okay, we've talked a lot about what Innovate Inc. has, the patent, the team, all the good stuff. But that is only half the story, isn't it? A smart decision means you can't just look at the shiny new toys. You have to look under the hood. A company can have the most amazing assets in the world, but if it's drowning in debt, you've just bought yourself a huge problem. So that's where we're going next. We have to do a deep dive on Innovate Inc.'s liabilities. What do they actually owe? And guess what? Just like with assets, liabilities get split into those same two buckets, current and long-term. Current liabilities, that's the debt that's due soon, within the next year. This is what tells you about their short-term cash crunch. Are the bills piling up? Long-term liabilities, on the other hand, are due way down the road. This gives you a sense of their overall financial stability. For our acquisition decision, we have to figure out if Innovate Inc. is facing any immediate cash problems. Because if we buy them, their problems become our problems, starting on day one. Whoa, okay, now this is interesting. Take a look. This isn't just a list of numbers. It's telling a very urgent story. You see that? They owe $500,000 to suppliers, due within 2 months. And they've got $1 million bank loan due in 9 months. Added up, that's $1.5 million in cash they need, and they need it soon. This is a critical piece of the puzzle. When you buy this company, you're buying that debt too. So the very next question you have to ask is, do they have the cash on hand to pay this? If not, you better be ready to write another check the day after you close the deal just to keep the company solvent. All right, so we've analyzed the assets, we've dissected the liabilities. Before we wrap up, I want to talk about the traps. These are the common mistakes I see students make semester after semester when they get a case study like this one. And trust me, these aren't just things that will lose you points on an exam. In the real world, these mistakes can cost a company millions and can cost you your job. Okay, number 1, and this is the biggest one, falling in love with the assets and completely ignoring the liabilities. It's so easy to do. You get excited about the cool new patent and forget to check the debt. You must always perform due diligence on both sides of the balance sheet. Mistake number 2, thinking goodwill is like cash in the bank. It is not. It's just an accounting placeholder for the premium you paid, and if that company's reputation or potential fades, that asset can get written down to zero overnight. And finally, number 3, confusing profit with cash. A company can look super profitable on paper because of non-cash expenses like amortization, but still be completely broke. That's why you have to look at the statement of cash flows. Remember this, profit is an opinion, cash is a fact. I want you to really let this sink in. Your job as you go out into the business world probably isn't going to be sitting there creating these financial statements, but your job is to be the person in the room who can pick them up and read the story they're telling. You need to develop the skill to look beyond the raw numbers, to connect the dots, and to ask the tough, insightful questions about why things are the way they are. That is what will make you a leader. And that's really the ultimate takeaway here. Mastering these more advanced topics, intangibles, goodwill, amortization, the nuances of liabilities. It's like learning a new language. It gives you the power to look at any business and truly understand its past, its present, and its potential future. So now you have the analytical framework, you have the tools. You can go back to that very first question we asked. Is Innovate Inc. worth $50 million? You might still say yes, or you might say no, but now you can make a decision that's informed, that's intelligent, and that you can defend to your boss and your entire company.